The pandemic has really flipped our lives upside down. Some things have really changed a lot, and this definitely includes the real estate space. So today I am joined by Simon, founder and managing partner at Elevate, and we're going to talk all about the changes that have been happening in the real estate investing space in Toronto. What this means is that you really can't invest in Toronto real estate with the same assumptions or do what you've been doing all along before the pandemic happened. In this video, we're going to reveal the 5 biggest mistakes that Toronto real estate investors have been making during the pandemic. But before we move on, remember to give this video a thumbs up if you enjoy content like this, or if you want to see Simon in more of these videos. And if you haven't done so already, please subscribe to our channel so that you don't miss other content like this made specifically for real estate investors in Toronto. Okay, so number one, Simon, tell us what the first biggest mistake is.
The first mistake that these investors make, and I see this all too common every day actually, working with investors, is using old rents to calculate cash flows. Yes, rents have gone down. Everyone knows it, but no one wants to believe that it's true. And so what's happened in the last 12 months to the year and a bit is that we've seen rents all across the board. Condo rents go down 15 to 20%, freehold rents go down 10%, and everyone's hanging on to those old rents and using those old rents to calculate their cash flows. And they're disappointed if they don't get those rents. And they're surprised almost, but every article, every piece of information, leases that have been done have shown us that the rents are down. So just make that adjustment. That's one of the big things, the biggest things that clients, investors are making a mistake on. And talk to someone who knows where the rental market is. We moved in, in Elevate, we moved in 20 units in the month of May.
Wow,
so we've got a really good grip of where current rents are in the current market, which are much different than a year ago today. So just make sure you use updated rents because your cash flow calculations will be all incorrect otherwise.
I've been doing a little bit of analysis between, Toronto and properties outside of Toronto, for example, like Pickering. So even though like places in Pickering, their rents haven't dropped, their property prices have actually increased a lot more than Toronto. So it's not just rent. When you look at cap rates, it's based on net rents and also the property's market value. So at the end of the day, even when the rents don't drop, but the property prices increases significantly, your cap rates essentially have gone down as well. So in my comparison, Toronto cap rates have gone down around 25%. And so have places outside the GTA, just simply because their property prices have increased so much more than Toronto.
Absolutely. Yeah. So bang on, you got it right. So a shift in marketplace, obviously, and we'll talk a little bit more about interest rates and the impact to interest rates along the way, having lower cash flows. But that is by far the most common mistake I see from investors today, hanging on to those old rents. Got to use updated rents, guys. Rents have gone down. And so you make those adjustments when you're calculating your cash flows. The second biggest mistake that I see people make is purchasing these buildings and multi-resident buildings without taking into consideration the risk of assuming tenants. So historically, everyone knows that the landlord and tenant board, the way that it's set up is it's very difficult if you have a tenant who's not paying rents to effectively evict the tenant. No surprise, during a lockdown, it's become substantially more difficult to actually get a tenant evicted if they're not paying rents. And so what we see now is that there are landlords that are listing properties for sale where they are asking the new purchasers to assume the tenants. And if the purchaser is not careful and not looking into in detail, they'll assume these tenants not knowing that they just don't plan to pay rent indefinitely. That is the second sort of major mistake, big red flag to look at. If you are planning to purchase a property with tenants, make sure you do the extra due diligence. And that goes into that is my third biggest mistake, is that a lot of these investors aren't actually doing their due diligence. And what's happening is they're just taking, what the listing agent is saying for granted and just saying, okay, like this tenant's paying X rents, should be fine, and it's all good. But they're not making the extra phone calls. So what we recommend is not only calling their previous landlords when you're checking tenants' rent, call the landlord prior to that. Don't just call the employer's contact that they list on their application. Make sure you go on Google, find the business phone number and call that phone number, because you don't know if they're leaving you their colleague's phone number, or if they're in fact leaving you the phone number of their direct manager.
Yeah, or their friend. It could be anyone, really,
Could be
right? Like,
anyone, absolutely.
why would they put a reference of someone that's going to give them a bad reference, right? So,
Absolutely.
yeah.
And the other thing is, I've seen this a lot more, and this has really been a function of the pandemic, is people are making cash deposits. Just don't take it. Just don't take cash deposits. People are coming to these showings with stacks of cash. It's very tempting to just take the cash and call it a day. But the quality of tenant that you're getting, the fact that they don't have the credit, they don't have the details, don't do it. It's a shortcut. I know everyone wants to keep their rents high, but because they're giving you cash, that you might find that by the third month they're not going to be paying your rent. And so that's something to be very, very mindful of, as we're still very much in the pandemic, in the peak of the pandemic, some would say. And so being very cautious and careful with the tenants that you're assuming, or the tenants that you're screening for, is probably one of the biggest things that I would recommend for investors. The next thing, number 4, this one probably isn't going to come as a big surprise, as it's been all over the news, is the cost and the timeliness of renovations, as well as the cost of the renovation itself as well. So everyone's heard in the news about wood prices, lumber prices. It's gone up 2.5 times since last year, and just supply of materials, and that's the one that you see in the news. But whether it's metal, it's plumbing, a lot of these materials that you take for granted to build and renovate homes, they're just not as easy to get now. It's all back ordered. One of the ones that my clients have been the most surprised with is appliances. Everyone's put an order for appliances, and it's taken months for these appliances to show up, and they have these fully renovated units and they don't have appliances to go in there. Mm-hmm. So just budget for that, budget for the extra time to renovate a place, budget for the increased cost in renovating a place. I think prices in general have gone up probably in around 20 to 25% overall. And that really leads into my last point, which is where our interest rates are. So the last mistake people make is assuming that interest rates are going to stay low. When you see lumber prices going up and a sense of prices across the board from renovation going up, it means this is the, by definition, inflation. And I think what we're trying to do right now is we're living in a world where interest rates are still very low, 1.8, 1.9, 2% interest rates, very competitive interest rates environment. And we haven't seen the inflation index reflect that. And what I think what we will see in the coming future, in the very near future, is inflation starting to catch up. And that will push interest rates and will have an effect on how your numbers are going to look like. And so keeping that in mind, I mean, it's just you'll have to look at your portfolio to decide, whether or not it's a good time to be fixed or to have a variable interest rate. But those are the things that I would absolutely consider as part of sort of the conversations that I've seen, the mistakes that I've seen that investors have made in the recent months, as we're still very much in the heat of the pandemic at this point.
Just to add to the interest rate. So yesterday, I know we're not in the US, but Janet Yellen actually mentioned yesterday that because of so much monetary easing in the US, she does see that interest rates are going to go up a little bit soon. So that's like a little bit of an indication that it's going to happen. And Canada typically, follows the US a little bit. So interest rates should come up. Maybe not so soon, but it is definitely on its way up.
Well, they also made that announcement that they were planning to move things up a little sooner. I think this was the most recent announcement, like a few weeks ago, where they said that they won't be holding interest rates low for as long as they initially intended to as well. So I think everything is trending towards that, and they're just making some adjustments and throwing some warnings out there to the public before they actually move anything at this point.
There's a popular saying that goes, when there's change, there's opportunity. So with these changes, Simon, where do you see the best opportunities are for real estate investors right now?
You know what? There's so much happening in real estate, and I always say to the clients I work with, it's always focusing on the submarkets and understanding the submarkets. Generally speaking, looking at where things are going and what's happened in the last year or so, there's going to be a continual push towards freehold properties across the city, both inside the city as well as outside the cities, you know, in the Richmond Hill, Markham, Vaughan areas, as well as people are looking for more space. I don't think that's changed. I think that's actually continued to increase in terms of demand for space and housing. So I think that's where things are heading. The main thing that's going to be looming over the demand is where interest rates are going to be and how yields are going to look. With the vaccines rolling, I think we're at 35% currently. Looking at the UK and looking at US, that where they're ahead of us right now, you can see their economies are really starting to bounce back, and people are starting to travel again. You know, people are going back to school actually, and so with that comes an increase in demand for real estate, especially in the core markets. So you know, I would argue certainly that we're at the bottom of the local, you would talk about the downtown core Toronto market. It should be going up at this point in terms of, you know, increase of demand for rentals as we are getting vaccinated at a higher clip than we've ever had. And we should be at a pace where, you know, just this week, they finally allowed people over 18 to get vaccinated as well. So I think this is all moving us in the right direction. And my general thoughts is it's great time now because it's quiet. It's not as busy as it was in the first 3 months of the year. And it's a situation where, you know, the market's kind of at its lowest demand point, where we think with the vaccines and people coming back to school, perhaps in September, in universities and so forth, that there would be a great time for markets to really start picking up at that point. So that's my general thoughts at this point in terms of where things are going, and we've seen a lot of it, you know, a lot of interest as well online. I think Samantha, you've been tracking some of the trends online with respect to people searching for real estate.
Well, this is actually from Google Trends. So I typed in duplex, I typed in Toronto condo and Toronto house. So I didn't type in Toronto duplex because not a lot of people search for Toronto duplex and it's not comparable on the chart. But if you look at the chart, you can see that more and more people are gaining interest in the search term duplex, whereas it's actually going slightly downwards for Toronto condos. So given what's been happening with the pandemic, I think a lot of people are recognizing the importance of positive cash flows, given this like shakeup. And there's just a lot more interest in purchasing properties that have better cash flows, so multiple units in a house and where you can get higher rents against your purchase price.
And that's exactly it. I think with the increase in demand, that's just going to drive rents up. And assuming interest rates aren't increasing very rapidly, which I don't think any of us would forecast, that would be pretty devastating from an economics point of view, that we're going to be in a market where prices are going to be appreciating and expanding. And so that's kind of our forecast for the next few months, certainly, with where all the indicators look like they're pointing towards, and the fact that vaccination rates are going up so quickly at this point.
Okay. So I think that's it for our video. So thank you, Simon, for joining me for this week's video. And if you are looking for an expert to guide you with your real estate investing journey, we are here to help you out. We at Elevate, we're a full service brokerage that specializes in real estate investments in Toronto. We help you buy, and we also have optional services in leasing and property management. If you want to reach out to us, just head over to the link in the description below. And again, remember to give this video a thumbs up if you enjoyed this content. And if you want to hear from us more regularly, look for us on Facebook, LinkedIn, or Instagram. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye, guys.
Bye.